Hey everyone, Signet here with the Bullish Bears. Now today I want to take a look at the Analyze tab a little more in depth than we've done before, or that I should say a little more in depth than in the last video. So let's start out with the fact that you don't actually need to be in a trade to analyze what's going on in the market with this thing. Right? You can use it right off the bat to look at expected move. And you can use that to plot onto your chart the week's expected move. So you can see here the date. This date box should be set for your current day. So for me, today is April 8th. It's about 12:48 p.m. You can see in the upper corner here, April 8th, 12:48 p.m. This is April 8th. Now, the reason that they give us this opportunity here on the Analyze tab is so that we can step through the days and see if we did have a trade on, what would happen to our Greeks, what would happen to our position, even without looking at a change in price, but only looking through a change in time. And the reason that is important is because your trade gains or loses value every day if you're in an options trade because of theta decay. And so your ability to step through time is critical if you want to see what could happen to your trade without even looking at a price change. Now we can add a change in price by coming down to this lower sprocket. You see, once I've clicked on it, I can now recognize the current price of this market, which is QQQ. It's at 184.52. That's also where my middle slice is at right here. You can see that it's got a dollar symbol, and this is a standard deviation symbol. The default is 1. In almost everything inside of Thinkorswim, the standard deviation is always going to be set to 1. That doesn't mean you can't change it. That just means that that's the most often measured metric when it comes to options and expected move. We can change what these slices represent, but for the moment, we just want to focus on the center one. It's on the dollar amount. It's showing $0 because we are equal with what price is at right now. The 184.55, 56, well, that's what our price is at here. And you can see that since we haven't moved up or down, it's set at 0. There's no Greeks applied because I have no options applied. Now up in this corner is what our deviation is going to measure. We want to know how far the expected move is between now, which is April 8th, and this date, which is April 13th. If we pop up the menu for the calendar, I should say, Friday is the 12th. Options that expire on a Friday are managed by the OCC on Saturday. So we like to set this date up here one day later than when the option would expire or when our week of trading would be over. If Friday the 12th is where our week would end, we could set this to 4/13. Now I'm going to move it back one, and you'll see that it doesn't change that drastically because we're only looking at moving one day out of this expected move. So now we are more accurately representing how far the Qs are expected to move between now and Friday's expiration. We can see that the deviation is between 181.32 and 187.85. Okay, so that's our range. Now, if you're wanting to put on a butterfly trade, for an example, for Friday's expected move, you could set this slices out to the chart, and then you can see those values represented in a way that may be more familiar to you, right? So if your chart or if your risk profile doesn't look like this yet, and if your slices do not look like the first thing you could do is come up to this action menu in the upper right corner, click on it and hit reset. Anytime you quote screw up this area, don't even fear it. You can always reset it back. It doesn't hurt anything, and it doesn't affect any of your charts or anything else. You won't lose any of your settings in the rest of your platform. All you did is reset the risk profile area. So if you ever get this thing all out of whack and it's just not showing you what you think you should be looking at, just go right up there and reset it, because it won't affect the rest of your profile or your account at all. Okay, so now that we've reset it, we want to bump this back up to the 12th. And you can see that we're still showing the 184.52, and that's where this center line is. Only now our slices are showing us a 10% move up and a 10% move down. I'm not interested in seeing a 10% move. I'd rather see how far this expected move is in the gray area. And I can now go to this Show Actions menu, click on it, Set Slices, and scroll up to this right here. Now, what this menu is saying is -1 deviation, current price, +1 deviation. If we read it word for word, it just says base +1 -1. But base is the current price right now. So you can see I've reset the slices to a deviation higher and a deviation lower. Now that's fancy language for just saying that's our expected move. So there's the bottom of our expected move, and there's the top of our expected move between now, 4/8, and Friday, 4/12. We could change this expected move right here and choose 2 deviations, or we could choose 3 deviations. Now, I'm not going to get too deep into standard deviations, bell curves, and all of that more statistical mathematics. Just understand that a single deviation, a 1 standard deviation move, means that all trades between now and Friday have a 68% chance of remaining inside of this. Now, that doesn't mean that it can't break out and move beyond these. That happens quite often. When a stock goes parabolic up or down, it can easily break its expected move and move beyond a single deviation. But typically, and going back for 20 years and looking at the overall market in general, stocks statistically stay within their mean more often than not. Okay, and so that gives us our ability to measure the move of what is expected. Now that is based on volatility. Volatility is a forward-looking indicator. It's one of the few indicators that I use and rely on day in and day out in all of the trading that I do. Volatility is critically important. Even when you don't recognize how volatility is affecting your trade, it's very important to understand that volatility is affecting a lot of your trade. From the options Greeks to the expected move, all of that can and is affected by implied volatility. Okay, so now that we know how far the Qs are expected to move up or down between now and Friday, we can put that on the chart to help us determine what type of trade we might want to take. The great thing about options trades is that we have a variety of trades that we can take. Each of them have their own criteria. Each of them have their own strategy behind it. And depending on what we see from price action, from the charts, support and resistance and price structure, volume, TPO, from all of that analysis, and including our expected move, we can then come back to the options table and start to develop trades that fit our portfolio and fit our time frame within our risk tolerance. Okay, so let's set these out onto the chart and look at it in a way that may be more familiar to you than the way we're currently looking at it. If we come back over here to this Show Actions menu, click on that, Set Slices to the charts. We can click on the first box that appears. And now you can see that it brought me out to the cues on the charts, and it put those slices there for me. So we have the current price, which we don't really need. And then we have our upper and lower ranges. We apply that to the daily chart. Now we've got a really great visual of how far the cues could move up or down between now and Friday. Now, right off the top, we could think about iron condors, which would mean building a credit spread above this price slice and a credit spread below this strike price. And when you put those two credit spreads together, that creates an iron condor. As long as price stays inside of our iron condor, then we would look to get paid at the end of the week. All right, so that's one trade that we could do. Another trade we could do is apply a butterfly to the top or to the bottom. And that way, if price moves up to its expected move, then we could look to take profits in that trade. Now, each of those will be affected by volatility differently. Typically, when price goes up, volatility goes down. Recently, that has not exactly been the case because we are stretching farther beyond our support, and that is causing increased risk. And so in the last 5 or 6 trading days, our moves up has brought volatility up with it. So we can't always say that when price rises, volatility falls. That is the typical thing that we can look at. And on an intraday basis, I'm sure that it would be applying more. But since we're extending so far beyond our support, we're actually increasing our risk as we're increasing our price. All right. But when looking at options trades, typically trades that you sell will be applied with volatility differently than trades that you buy. All right. And iron condors, a trade that we sell. The butterflies are trades that we buy. So each of those would be changed completely different from each other when it comes to volatility. And we can use the Analyze tab to identify how volatility would help our trade or hurt our trade. Now, another thing that we can do, looking at our range-bound market in these last few days, is we could put on a diagonal or a calendar for a very short duration trade. And we kind of like those more often when we can identify a slight pullback or a stalled market. When looking to put on weekly trades, the list of trade strategies are more limited because our risks in those short-term trades are greatly exaggerated because of gambling. And that's something that we got to keep in mind. Okay, so this is one way that we can look at our expected move. And we got that expected move by looking at it right here. And we just applied those lines out to the chart. That same expected move is also right here. 4 days to expiration. That would put us at 412 for Friday. And you can see the expected move is $2.45. Now we want to round up and we'll call that 250. That means that the cues could move down 250 or they could move up 250. All right, so that gives us a $5 wide expected move between now and Friday. Now, because of volatility, as I was saying, one of those trades, the butterfly, would be affected completely different than the other trade, the iron condor. Depending on your brokerage platform, we have been working on developing what we've been calling the double butter. When I was taught the weekly expected move butterfly strategy, I was taught to only build it on the top or the bottom and not to build it on both, because the commissions for a butterfly that is 3 legs and it is 4 options. When you're looking to get into a low probability, high payout trade, you're looking to build it for around $4 or $5. If you add $4 or $5 in commissions to that, you're now looking at a $10 trade that has an 8 to 10% chance of success. Okay, so putting it on both sides increases your risk, but not necessarily increasing your probabilities by very much. And that is not risk reward ratio that's appropriate. Putting your butterfly on both of the expected moves does not guarantee that you'll make one or the other. And quite often you can end up in the middle of both of those and lose them both. Okay. However, because of Robinhood, we can actually place that trade on the bottom side and the top side and not risk any more in that double butter than we would by building it on either side in Thinkorswim. Another thing that we can do with these price slices is, I'll show you an example here. So this is my typical day trading setup. And I had to go in and put these lines onto the chart because I wanted to see the VIX in these 5-cent increments. Instead of going through and just drawing each of these lines using the drawing tools, I applied these lines to the chart by using those price slices. And the same here in the advanced decline. You can see these lines have been applied in $25 increments. And I did the same thing here. Now, I did have to color coordinate them, right? So later on, I had to go in and change these to the colors that I wanted. But I was able to apply these to the chart by using those slices. And the same with the tick chart. Did it the same way. Right? It's a very useful function to be able to set slices onto the chart even without necessarily looking to take a trade. Right? Perhaps you just want to see price in different increments, say 25 cents or 50 cents or $1 increments for whatever reason, especially on an intraday basis. You can go in and you can set these slices to that. So we can add and remove slices just by right-clicking anywhere in this area and going to Add Slice. They default at 0. But we can add as many as we want and we can apply them to the chart. This little tab inside of the price slices lets you know what it is that it's calculating. This one is set at deviations. And this one is set at money. Now that I've set it to money, I can move over here and I can choose the dollar amount that I want. If I click on this and I don't see a dollar amount that I want to apply, I can just click on it, double click, delete that, and I can apply my own amount, say 50-cent increments. All right? So you can go through and you can set these 50 cents, 5 cents, 10 cents, whatever it is that you want to apply. And when you're done, you can come back over here to the Show Actions menu, set slices. You can use either one of these. You can set slices to chart right there. or you can set slices, go to charts, and then come back over and put it right there. And that would send all of these slices out onto the chart just like we did a little while ago. They will be drawn the way your default line drawing tool is set. You can see that mine is a lightly shaded gray dashed line. But if I go in and I set my drawing tool, let's go to the drawing tools and draw a line. So this is the tool, price level, that is going to be used when price slices are applied to your chart. You can see that I drew a line right here, price level 1, which is different than price slice 1, price slice 3. Now, you can just apply a price slice to your chart, right click on it, edit properties. Now within this box, you can choose the settings that you want and then save it as default. And the next time price slices are set to your chart, it will show up the way that you've got it set to show up from now on. So if, for an example, we go with cyan, width of 2, a more spaced out dash. Suppose we don't want the name, so we can turn the name off, and we do not want a left extension, so we can do all of that, set it as default, and now you can see that would be our new price slice. We can check that going back in there and actually applying slices to the chart. This time I'm going to choose $2 and $5 up, $2 and $5 down, and the middle where we're at right now, I don't need that one, so I could look to delete that slice. And now it would just be these 4 slices. We can apply that to the chart. And there we go. It's exactly what we did before. We just changed all of the slices, colors, and settings beforehand and saved them as default. The next section I want to focus on is the commissions. Very simply, you can include or exclude your commission rate from the analysis that is performed on the trade that you're wanting to analyze. The default is to exclude. I oftentimes go up and turn this over to include, but if you reset, like we spoke about earlier, that will set that back to exclude, and you would have to come in again later on and turn it back on if you wanted it to include the commissions in your analysis. The next thing we can focus on is this area here, which allows you to analyze trades not just with a single volatility, but with multiple lines of volatility. And when I turn that on, you can now see the Qs have a volatility of 16.98. That's our current volatility. And it's going to apply 5% volatility to 4 more lines, which is what we see here. Each line is going to be separated by 5% of volatility for the next 4 lines. We could do 3 lines, or we could do 2 lines, or we can do 1 line, and we can choose how far wide apart we want those lines to be based on volatility. So that's what this step is called. You can go to 4 lines of volatility. They are stepped 5% apart. That's a default setting. You can change that. It doesn't hurt anything. It just means that there will be more or less volatility between each of these lines. P&L at open, P&L at day, delta, gamma, theta, vega, and rho. Now, rho is hardly ever going to be used in any of your analysis, but you could find the opportunity or the need to analyze things based not on money, but more on the Greeks. You have that ability here in the metric button. So here is a debit spread that I built straddling price. We can see that price is 184.73. This strike is 184.5. The other one is 185. That means I built this debit spread straddling price. I did choose the April 12 expiration. We do have our expected move applied for 1 day past. And now I can answer the question, could the Qs move up enough to make it profitable for me in this time frame? Now, I like to manage my positions at around a 55 to 65% profit. I do not aim to take max profit in a trade like this. So I'm not worried about reaching this goalpost way up here. The standard deviation, the expected move, is showing me that yes, this $27 trade, if we called this 25 cents, and I wanted to make 100% profit, I would look to sell this trade for 50 cents. How much would I need to see a move to make that 50-cent profit? I can set the slices to dollar amounts. I can set it to $1 up, $1 down, and now I can see if it moved up $1, what would my profit be on this trade? $1 move up, I would profit $9.67. If it went down, I would lose $4.50. I need to see a profit of 50 cents. So that's 25 cents greater than where I'm at right now. Now we can calculate that. Say I want 50% profit. 55. That way I can cover commissions. So I take 0.25 multiplied by 1.55. I could put in my order and then put in a sell order for 38 cents. Now, 38 is where we're at. Subtract 25 from that. We need to see a move of $13. A $1 move up would not give me my $13 move that I'm looking for. So what about $1.50? So now I can see a $1.50 move up or a $1.50 move down. A $1.50 move up does get me closer to my 55% profit target. We can see that I could make $11.75, $12.16 now because the market is alive and moving. We are on an intraday market. And we can see that it still fits inside of our expected range. Even though I've moved these lines, I have not moved the date. And so this gray box is still representing my expected move between now and Friday. The lines now are just showing where I set my slices. So I could look to get into this trade for $25. That's my max loss. And my max profit is showing $25 also, but I would only look to take profits at around 50-55%. This line tells me how far that would be. Around the 186.20 area. We didn't have to dial it in perfectly. That would just be a pretty close estimate. So that's another great way that you can use these slices to help you identify how big of a move you might need before you see your profit target. Because this price slice is using and applying the Greeks to your position to help you calculate the profit and loss at this time. Now, this does not apply to any other day except for this day showing in this box here. You can move forward in time. You can see that the next day would have less volatility left. The expected move has gotten smaller. And now it's showing how much we could make or lose if price moved up by $1.50 between 4 and 9. So on that day. Okay, so that's us walking through time. You can see that by Friday, the day that this would expire, the blue line that we've been looking at is starting to closely resemble what we would make or lose at expiration. You can also see that while we were doing that, the move that we would need to see our profit changes what our profit would be. Okay, so if I start clicking back through here again, this is Thursday the 11th. A $1.50 move would give me a profit of $15.26. Okay, because as we were clicking up through time, this line became a lot steeper. And so a move within that time frame would mean that we're making more profits quickly. It's a great way to kind of visualize what your profit could be and how fast you might need to see a move before falling down into this area, which is where your loss is below the zero line, because here is the zero line. Now you can change the colors of your profit and loss at expiration, which is the line that I keep faded into gray, and your profit and loss right now on the day that we're showing, which is in cyan. You can come over here into this area, right click, change the colors. So now you can see that my cyan line is red. Oftentimes I'll set that one to blue or green, and I'll set the other one to red or orange so that I can more easily identify where my target profit, where my max loss, and where I'm at right now. You can see that those colors really pop on this gray background. I often look at my max loss in this way because this does represent your max loss in the trade. But I rarely ever look at my max profit in this way because I'm not looking to hold this to expiration. Okay. This red line in no way is a representation of what you could make in a debit trade unless you're going to hold it all the way to expiration, which I do not recommend anybody do unless you have a very clear understanding of assignment and risk. Okay. A credit spread is completely different. Holding that one until expiration carries its own risks, but having options expiring in a credit spread can be highly beneficial if you understand the strategy applied to it. But for the most part, when it comes to debit spreads and most options trades that we're going to look at, you would not hold it into expiration. So this profit line that I am showing here in red would be something that you would not expect to make. Now that doesn't mean that I can't make the full $25 before expiration. I absolutely could. For an example, if a few days go by, now you start to see that that green line is shaping and forming into what our expiration would be. So here's Thursday, 4 days from today. If the Qs moved up to $90, before expiration, I could make almost the full $25 profit. I'm 7 cents away from making that. You can see that I'm still not making it, I'd have to move all the way out here. Still not making that full $25, even all the way up to 210. I'm 1 penny away from making that full profit. Okay, so that shows that you can get very, very close to making a full profit before expiration. But it's almost impossible with a debit spread to take the entire full profit that it shows here in red. So you never want to calculate that as what you could make between now and expiration, because it's almost impossible. I'm not going to say that it's completely impossible, but you would need a massive, massive move to the top side before you would finally see that profit. Right? A more realistic profit is the green line. And we can examine that green line between now and expiration by moving through the dates set down here. Changing the dates up here are only going to show you an expected move in this gray area. It does not help you identify your profit and loss potential in the trade. While I have this trade built, I'll go up here to the lines +1 at expiration, and I want to apply volatility to this. So now you can see if I apply volatility, our volatility right now is 16.93. That's our current volatility. I asked to show one line 5% away, and now we have the red one, which is showing us our profit or loss if volatility went up 5%. And you can see that that hurts our profit in this trade because this is a debit spread, and a debit spread is reduced when volatility increases. So it reduced our max loss depending on where we land within this time frame, not our overall max loss, but it reduced our loss amount, right? And on the top side, it reduced our max profits. Not at expiration, remember the solid line that we were looking at earlier, but our P&L right now, our current P&L. And then we can move through the days and identify how those change the closer we get to expiration. We can apply more steps by going up here, setting the steps to 4, and now we can see our current volatility, which is here in green. That's our current real P&L, and then 4 other profit loss lines separated by 5 points of volatility. Now this doesn't have to be applied to the plus side. You can also apply it to the negative side. And you can see how much profit is reduced or gained by the change in volatility. All right, so I applied a -5 volatility to this trade, and you can see how that greatly affected our trade. Now, if we were to get into this trade with that much volatility applied to it, we would start out ahead by $2.50. A $1.50 move would make us $12, and a $1.50 move down would cost us $7. If I take the minus out of this volatility and we just show it the way that it regularly sits, you can see when I hover over this line what our profit or loss could be as volatility expands upward in this trade. The purple volatility down here is 5 points between each of these slices. So from 16 all the way up to 36, that's doubled the volatility. We would be going from a 16 vol to a 36 vol. More than double the volatility, right? And you can see that it would cost us in our trade accordingly. As I move my mouse across the screen and move past where price is at right now and move up into this area, you can see that as the volatility expands in this trade, our profit is reduced. And that's what this volatility lets you do up here. It lets you change and visualize how much your trade could be affected by volatility. And like I said, we don't have to leave this at 5. We could set it to a lower amount, because honestly, expecting a 5-point move in the Qs would be pretty extreme. Expecting it to change from a 24 or from 16 to 36 is seriously exaggerating what could actually happen to the market. So to be more accurate, we could try to apply just 1% of volatility and then move our mouse over here to visualize what our profit or loss could be for that. So now that you've got a very good understanding of the volatility step, let's set that back to expiration, puts it back to the way that it was. All right, so now that we've talked about that, let's talk about looking at the deltas, the gammas, the thetas, and vegas. So I'm looking at this debit spread down here. It's got a Friday's expiration, 4 days from now. We can go over to lines, set it to single, and instead of looking at our profit or loss as price moves up or down, we could analyze each of the Greeks and how they would be affected as price moved up or down. So here, for an example, we have gamma. Our current price, 184.84, is this line right here, and you can see that as price rises, our gamma would decrease in this trade, and then past a certain point, our gamma would begin to rise again. Now, there's not a lot of value in looking at this particular trade at this particular time, because this would not offer us very much. You can see it's 50 cents and then $1, $1.50, and then $2. If price was to fall through the day, our gamma would increase to a point and then it would start to fall away again. That would be how much gamma is applied to the delta after each dollar move that we would make in the underlying stock. Thinkorswim gives you the ability to do this so that you can see how your trade would be affected as you start to move through time. And as you can see, your trade can be greatly affected by volatility, by delta, by gamma, by each of those as the trade goes on, and that's what it is allowing you to visualize. There are reasons to be able to do this, especially if you're putting on a intraday trade on a 0-day expiration trade. So for an example, if we was looking at SPY, today's Monday, that means it has a 0-day expiration trade. These options will be highly volatile and greatly affected by gamma, especially in the later part of the day where we are now. You can see that it's 1:45, almost 2 o'clock. The gamma in these would be greatly exaggerated, and these trades would be highly affected by volatility. Okay, so let's go back to the Qs and back to the Analyze tab. So this does give us the ability to change our single line to each of the Greeks and see how they are applied. We know that each day theta is added or subtracted from our overall trade, depending on if we buy it or sell it. We are buying this trade. As price rose through this single day, we could see how our theta could increase or decrease depending on which way the stock went. Again, they give you this ability, but there's very few reasons for anybody to actually need to analyze these Greeks. That doesn't mean that you can't do it or that you can't find value in it. Just for the most part, people either leave it on P&L day to see if they're, say, already in a trade, how their trade is doing, or if they're looking to get into the trade, how much they could make or lose on this particular day. And again, as we move through time, what we could make or lose changes because there would be less time left in there. The Greeks would be applied differently. There's less volatility, right? So setting it on single can be useful, especially if you're not looking to see the P&L at expiration. But changing this metric from P&L open or P&L day really should only be applied when you set this to single. And looking at this does not give you a lot of analytical edge. It's not going to really help you out any, right? But at least now you do understand why it's there and how you can use it. If at any time that you get these all messed up, maybe get confused about how it was before you got to changing a lot of the settings, you can always go up here to the actions menu and reset everything. It's fine. It won't hurt anything to do that. Okay, so now we've talked about the metric. Now let's talk about probability mode. So when we were looking at that gray area, that was our deviation. Now we're looking at the opposite from being in the money with a single deviation, right? That's what our one standard deviation is. Between now and expiration, we can set the slices. So the Q between now and Friday can move from this point to this point. We could also, instead of wondering if the Qs will move within our range, what's our chances of it being outside of this range? Now, if you notice these numbers up here at the top, if you add them together, 34 and 34, plus the decimal and whatever is left to the outside of it, it's supposed to calculate and add up to 68.27. Because 68.27 is one standard deviation, and that's what all of this area is. What's the chances that the Qs would move below our lowest deviation? There's a 15% chance. You can see that right here. What's the chances that it'll move above our deviation? There's a 15% chance that it'll move above. We can set the probability of being in the money to the probability of being out of the money. So the slices are still the same, only now the black area represents our deviation and the gray area is our probability of being out of the money. So our probability of being in the money, what's our probability that this would be in the money? 15% chance. What's our probability of this being in the money? 34% chance. And 34% chance and 15% chance. Out of the money uses a different probability. So it not only changes the color of what our deviation move is, what's the chances that this area would be out of the money, that the Qs would move all the way down here beyond our expected move? 84% chance. 65% chance. Now, being in the money or out of the money would mean looking at our strikes. Our strikes are the 184.5 and the 185. For them to be in the money or out of the money, what's the chances of that between now and expiration? That's the probabilities that are shown up here. Okay. When you're looking at probability of out of the money, remember that that is not probability of success. That is asking the question, what are the chances that between now and expiration, at expiration, that these shares or these options would be out of the money? Well, since we're not going to hold it until expiration, we do not want to use probability of being out of the money or probability of being in the money to calculate our probability of success, because we do not hold debit spreads to expiration. So we don't care what our probability is for being out of the money at expiration. So this last one is probability of touching. This one I find most useful when I'm looking at butterfly trades. If you see here where at the money is 184.76.75, you can see that's our current price. Our probability of touching that is 100% because that's where we're at right now. But I can grab it and move it. What's our probability of touching the 186? We have a 72% chance of touching that. Now I find that useful. So you can see I can come down here and I can delete slices. And that leaves me just one slice. And now I can set that slice to whatever I want. If price is at 184.75, what's the probability of touching the 185.75? I can put that in down here. The probability that we were going to touch 185.75 between now and expiration is a 78% chance. All right. So not only can you use these price slices to identify moves up or moves down, you can set probability of touching with your slice to identify your likelihood of moving up to that range at some point between now and the expiration or the time period that you choose. So I can move this to 187 for an example. What's the chances that the Qs will move up from its current price of 184 and go $3 higher to 187 between now and expiration? I can see I've got a 41% chance the price will move up here. Doesn't mean it'll stay there. Doesn't mean it'll rise above it and stay above it. It's just saying that there's a 41% chance that price will move up to this area between now and expiration. So I hope that this video has helped everybody kind of get a better understanding of how to use the Analyze tab. We didn't exactly cover every single feature in this risk profile, which is what this part of the Analyze tab is. The few things that I didn't cover were model, and that's because we don't need to apply different calculations to the way that our options Greeks are applied. I do like binomial trading strategy mathematics. Binomial is kind of if then else. So for an example, if price is at 184.84, what can price do? It can go up $1 or it can go down $1. So we would look at a binomial trade as if we're at 184, call it 185, what could it do? It could go down $1 to 183, or it could go or 184, or it could go up $1 to 186. And from 186, well, what could it do? It could go down $1 back to 185, or it could go up $1 to 187. So that's what binomial mathematics is if then or kind of formula. So I do like that one. But there's the Black Scholes is an entire video all by itself. There's no reason to ever change this. If you did want to change it, I would recommend choosing the binomial. It really just is how the Greeks are going to be applied to the analysis of this trade. It's not something that you should focus on a daily basis. It's not going to drastically change your calculations. You can see that I've been flipping through here at all three of these, and it's not really changing what's going on, right? So we don't need to spend any time really focusing or considering the model of mathematics. When it comes to groups, these are based off of the monitor tab for activity and positions. In that area, I've broken my trades that are in my portfolio into groups. I have naked trades, I have ratioed trades, I have butterfly trades, debit spreads, credit spreads, and so I like them broken out into their own groups. And this allows me to look at what's in my account portfolio right now, whether they are my vertical bullish trades or my unbalanced butterflies, my naked options, and it'll just show me what trades that I have. Not necessarily applied to the Qs, but in overall. Okay, so that's the groups part of this area down here. The single symbol, you can swap it over to beta weight, and this is useful if you're applying hedge material, right? So for an example, if I wanted to trade two different indexes at the same time, using one for my hedge and one for my trade, like we do with SPY and the Qs. It's a completely different video that we can skip for now. But if I wanted to see how that was going to apply to change my overall delta in aggregate, or my gamma in aggregate, we could set that to beta weight. And so now it's not just showing me the single symbol that I'm looking at here in the Qs, but rather it's allowing me to build hypothetical trades and then look at them combined from more than one symbol. So for an example, the Qs or futures products, right? Or anything else that we might build and apply down here. You can see I've got KALA, Disney, LSCC, BTN, different trades. And these are not ones that I necessarily have tried to bait away in this example, but rather they're just different trades that I've analyzed, and Thinkorswim saves them. So it doesn't help to go in sometimes and just kind of delete this area, kind of clean up all those old trades that you might have analyzed, and maybe make your Thinkorswim run a little bit quicker. All right. And you can see that now that I've deleted all of those, it's now showing the actual trades that I'm in. And I can start to apply them, look at the overall delta, the gamma. I can treat my portfolio in aggregate, looking to perhaps take trades to get into a theta neutral or beta neutral position. That's a lot more advanced analysis and deals more with the video that I'm looking to put together, dealing with helping people apply all the Greeks to their overall portfolio and getting into trades that help them hedge their positions, protecting them against, massive downturns in the market or whatever. The all one series down here would show you if you had more than one trade applied to this single symbol that you're looking at, what I call market. So our market would be the Qs. If I had multiple positions in the Qs, I could choose to click on this button and show or not show trades that I'm in right now. I was in a trade earlier today. I'm no longer in it, and that's why it's showing quantity at 0. Thinkorswim hasn't updated our portfolio until after market close. And so it's still giving me the option to show this trade even though I'm no longer in it, which is why when I click on it, you don't see anything show up here. There's nothing to analyze. I've already gotten out of the trade. But that all one series is asking what trade exactly were you wanting to look at. The April 26 weeklies is what shows because that was the trade that I was in. And then for here where it says show all, if I want to analyze a trade, for an example, this one, if I had a position on, it would interfere with the trade that I'm trying to analyze. And I would need to go in and turn my trade off, hide my position, so that I would be analyzing the trade that I built and not applying that trade to the positions that I'm already in, which is something that you absolutely can do. If, for an example, I'm already in this trade and I wanted to apply an extra call, for an example, to give this an upside boost, I could go in and look to take a single call, suppose at a different expiration, maybe a shorter term trade, and I can send that over to the Analyze tab and then look to turn it on or off and see how it will affect the trade that I'm in or that I'm interested in taking, right? Because not only could we look to get into a trade like this that has, for an example, maybe a later date, we could look on the shorter term to apply maybe a little boost to the upside, take profits as we moved higher, and then exit out of that trade, still being in the other one that we had built and just having collected a little bit of extra money in the trade. We could identify our profit in such a situation by using the Analysis tab to do that. So in our next video, we're going to focus more on analyzing trades that we're looking to get into and different ways that we can apply that analysis, like I did a moment ago by adding this single call to the trade that I was looking at. And we'll get into different ways of looking at the profit loss and what we could make or what we could lose by applying different leg options, different strategies, and different ways that we could analyze it. I wanted to focus mostly in this video on the different buttons, this price slices, sending them out to the charts, what the dates were here in these two different boxes, what this changed for us, setting the lines. And so that's what we covered today. And I want to thank everybody for watching, and I look forward to seeing you at the next video.